Hi everyone, it's Jack back again with another video. Today we're going to talk about MNDY.com. Really interesting stock. June 2021 IPO. Only down 9% since its initial few days trading. However, the stock is down 63% from its highs in November last year. Absolute roller coaster of a time since IPO. Trades some sky high valuations and more than 50 times sales. Wanted to establish, is it a buy since this drop? MNDY is a pioneer in workplace software, trying to make essentially a work operating system. A single platform where employees can manage and run all their everyday work with a ton of customization, additional modules and features. It's a really novel approach that clearly emphasizes being flexible and adaptable to the needs of each customer, and they want to create a single unified workspace that integrates all tools, aggregates data, and all in all streamline many workplace tasks. Since the product launched in 2014, MNDY has added a ton of new features, constantly expanding its market and its value to customers. You can see in just 2017, they had very few features and not a lot of revenue. And now going from $11 million in revenue in 2017 to $308 million in 2021 is truly incredible. In that time, they've added columns, views, sales partners, automation integrations, 13 languages, apps marketplace, WorkDocs, MyWork, WorkForms, Canvas, and more. These are just the most significant ones. I love to see software companies like this pushing the bounds of its market and showing true optionality, and also massively increasing the value to its customers. The market for MNDY's services are enormous and growing. The total addressable market is $56 billion from the company's own predictions, with the majority of that, around $22 billion, being collaborative applications and the rest being project management, marketing campaign management, CRM and software development, all of which are multi-billion dollar segments in their own right. Of course, the company continues to push itself into new markets, and the sky's the limit really. They believe that the wider market trends will obviously support this organisation to continuing to digitise many aspects, if not all aspects of the work, and work is becoming much more distributed, cross-functional and reliant on software. I think this can only be good for MNDY. I think this total addressable market will be rising at a significant compound annual growth rate. The financials for MNDY shows why it trades at such high premiums and are what I really care about here. From 2019 to 2021, 99% compound annual growth rate, very, very impressive. Just shy of got a doubling from 2020 to 2021 and doing more than that in the previous year. They're still a young company, remember, the numbers are really starting to get quite big. Now more than 150,000 customers, no customer concentration here whatsoever. Greater than 135% net dollar retention rate of significant customers, or those they consider with more than 10 users, which I think is a fair way to calculate this. 382 million in annualized revenue run rate, very impressive for such a young company, and this is growing rapidly, as you can tell. The most impressive thing of all this for me, and why this will command such a large valuation, is 90% gross margin. Absolutely ridiculous. These sort of gross margin numbers are reserved for the elite of SaaS companies. Growing at 100% a year, 90% gross margins will get you a hefty valuation. It's kind of starting to make sense why when this initially went public and it started producing some numbers, it was trading for 50 times sales, which is obviously ridiculous. Key to any SaaS business is, of course, landing customers and then expanding sales within these companies. As 135% net dollar retention rate for significant customers, very impressive. They're doing a good job of this. Incredible growth with customers with greater than 50,000 annualized revenue run rate since Q1 2019, from just 9 in Q1 2019 to now 793. Again, keep saying this, still a relatively early stage company, but that is absolutely mental growth. 200% year over year growth just this year alone in these customers. These are the ones that are going to be doing the majority of the revenue. This is where the revenue is going to be concentrated, but they have 150,000 customers. It's not going to take long for this number to be rising quickly. Seems like the business is really picking up momentum within its bigger customers, but as the switching costs go up, as they take on more modules and more features, this is bound to happen, and it's a really, really bullish statement for MNDY, in my opinion. MNDY's stock price today is $162, so roughly a third of its 52-week high of $450. Still, even at today's prices, the company has market cap of $7.8 billion and around $380 million in sales. Still a significant 16.5 price sales going forward. The company is not profitable as it stands, so there's no other metrics to look at really other than price of sales. And that is significant, particularly in today's market where these type of stocks are getting battered. And you can see why MNDY has been battered from its highs, which admittedly with far overblown price sales well in excess of 50. To summarise, I think this is clearly a fantastic company, just really getting a foothold with its market and customers. It has 90% year over year growth, 90% gross margin, and 130% net dollar retention rate. absolutely incredible metrics for any SaaS company. And this is not one that has no revenue. We're talking 380 million in ARR now. Seriously impressive numbers and a nice big and expanding TAM to grow into. Solid cash position of 800 million with next to no debt. This growth seems sustainable for me, at least in the short to medium term. Company checks a lot of boxes. Going to be digging a bit deeper into the coming days because I don't fully understand everything about the software at the minute, because I like to know that before I invest in a stock. But it's looking thoroughly investable to me. Price sales around 16 is starting to look more reasonable based on these incredible financial metrics. That 90% gross margin just keeps jumping out at me as incredible. I'm a bit concerned about investing companies with 15, 20 price to sales in today's market, in what is potentially going to be a higher interest rate market. But some companies you just have to take the leap of faith on and start a small position, and that's what I'm planning on doing. Of course, none of this is financial advice. If you want your own financial advice, speak to a registered financial advisor, and of course do your own due diligence and research. I'll see you again next time.